Have you ever wondered what happens when a significant financial institution collapses in the US? The collapse of the Silicon Valley Bank serves as a prime example. In the early months of 2023, Silicon Valley Bank, a significant player in the financial industry, collapsed. This collapse was primarily a result of poor management and difficult economic conditions. The bank had made a risky bet on low interest rates, which backfired when those rates increased. This misstep underscores the importance of sound decision-making in the banking sector, where one wrong move can lead to a domino effect, causing severe repercussions throughout the economy. In response to this crisis, the Biden administration took immediate action to contain the bank's woes. The Treasury Department, along with federal regulators, assured there was no systemic risk to the banking system as a whole. They rolled out emergency measures to prevent a run on small or regional U.S. banks and guaranteed the deposits of Silicon Valley Bank's customers. These swift actions were aimed at alleviating immediate stress in the financial markets. However, the collapse of Silicon Valley Bank also served as a catalyst for a hyper-politicized reaction from both sides of the aisle. Republicans blamed the bank's collapse on socially progressive investments and government intervention in the economy. They pointed fingers at Biden's spending policies for high inflation. On the other hand, Democrats called for more regulation of the banking industry and blamed the situation on Trump's regulatory rollbacks. This partisan mistrust and the ensuing blame game highlight the routine political fracturing in the United States. They also raise concerns about the ability of the government to effectively address future financial crises if the situation worsens or another financial crisis occurs. The administration will need to partner with Congress to address the issue, as was the case in 2008 during the Great Recession. However, the current political atmosphere makes it unlikely that the parties would unite on common action. The collapse of Silicon Valley Bank not only highlighted the risks of polarized politics, but also sparked a blame game, making it harder to address the issue effectively. When a financial institution of such significance collapses, the aftermath is often chaotic. Let's explore the immediate actions taken by the government to prevent further financial contagion. In the wake of Silicon Valley Bank's collapse, the Biden administration swiftly leaped into action. They rolled out a series of emergency measures aimed at containing the financial fallout and preventing a wider economic crisis. The Treasury Department, alongside federal regulators, assured the public that there was no systemic risk to the banking system as a whole. Their primary concern was to prevent a domino effect, a run on small or regional U.S. banks that could further destabilize the economy. To this end, the government implemented measures to guarantee the deposits of SVB's customers, a move designed to restore faith in the banking system and prevent panic withdrawals. In addition, another failing institution, Signature Bank, was promptly shut down as part of these emergency measures. The government was adamant that these moves would not be financed by U.S. taxpayers, a sticking point that had caused public outrage during past financial crises. The administration's quick response was intended to alleviate immediate stress in the financial markets. President Biden assured Americans that the banking system was safe and promised to do whatever was needed to maintain this stability. The ghost of the 2008 financial crisis loomed large in the public consciousness, raising concerns about potential bailouts and the government's role in the economy. The Biden administration found itself walking a tightrope. On one hand, they needed to prevent a deepening crisis that could spell a political disaster. On the other hand, they had to fend off criticisms from Republicans who blamed the crisis on Biden's spending policies and the loosening of financial regulations under the previous administration. While these measures might have alleviated immediate stress in the financial markets, the question remained: would more sweeping action be necessary? The collapse of a significant financial institution has a ripple effect on the economy. Let's dive into how this event influenced the U.S. economy. When a bank as prominent as Silicon Valley Bank collapses, the impact is felt far and wide. It's like dropping a stone into a calm pond. The ripples spread out, touching everything in their path. The first ripple we saw was a slowdown in the gross domestic product growth. The GDP is like the economy's heartbeat, and when it slows down, it's a sign that the economy isn't as healthy as it could be. This slowdown didn't happen in a vacuum. Companies started announcing mass layoffs, a clear indicator of economic distress. When businesses have to let go of their employees, it's often because they're struggling to keep their heads above water. And when people lose their jobs, they spend less, which in turn affects other businesses and slows the economy even further. Then there's the issue of inflation. Now, a little inflation is actually a good thing. It's a sign that the economy is growing. But persistently high inflation, that's a different story. It means the cost of living is going up, but wages aren't keeping pace. People can't afford to buy as much, which can lead to a decrease in demand, and businesses suffer as a result. The collapse of Silicon Valley Bank also sent shockwaves through the banking sector. Regional banks, which are integral to local economies, experience turmoil. These banks are often the backbone of small communities, providing loans to local businesses and helping to stimulate economic growth. If they're in trouble, it's a bad sign for the economy as a whole. And let's not forget about First Republic Bank. This is another significant player in the financial sector, and there's potential for it to follow in Silicon Valley Bank's unfortunate footsteps. If that happens, it could cause further instability in the banking sector and the economy at large. The collapse of Silicon Valley Bank triggered a series of events that caused a significant downturn in the US economy. The future is always uncertain, especially in the realm of economics. However, top economists have made some predictions about the fate of the US economy following this financial disaster. As we stand at the precipice of economic uncertainty, these predictions serve as a beacon, illuminating potential paths that lie ahead. Among the forecasts, one common theme emerges: a potential recession. It's a chilling echo of the past, reminiscent of the financial crisis of 2008. Some economists are predicting a recession by as early as September. This could be accompanied by a credit crunch, a situation where companies and individuals find it harder to borrow money due to banks tightening their lending standards. In addition, the commercial real estate market is in the crosshairs of some predictions. With banks like Silicon Valley Bank collapsing and others potentially on the brink, the fallout could send tremors through the real estate sector, leading to a possible meltdown. However, not all predictions are gloomy. There are also forecasts emphasizing the need for large institutions to adapt quickly. This could be an opportunity for growth and innovation as these institutions navigate through the choppy waters of financial uncertainty. But amidst these predictions, debates continue to rage over the Federal Reserve's strategy. Should they ease their interest rate strategy to prevent further exposing vulnerable banks? Or would pausing the rates strategy exacerbate inflation, damaging the wider economy and spiking unemployment? These are the questions that the Federal Reserve and indeed the nation grapples with. While predictions can provide some guidance, the future of the US economy remains uncertain, with debates about the best course of action continuing. The path ahead is unclear, and it will require wisdom, courage, and perhaps a little luck to navigate it successfully. But one thing is for sure: the decisions made now will shape the economic landscape of tomorrow. The collapse of Silicon Valley Bank and its subsequent impact on the US economy is a complex topic. Let's summarize the key points we've discussed. The fall of Silicon Valley Bank, primarily due to poor management and unfavorable economic conditions, has ignited a fiery political debate. The bank's collapse has been met with a highly politicized response from both Republicans and Democrats, revealing the significant risk that polarized politics pose to the stability of the banking system and the economy. In the immediate aftermath, the Biden administration took swift action to contain the bank's woes and prevent a run on small or regional U.S. banks. The Treasury Department and federal regulators reassured the public that there was no systemic risk to the banking system as a whole. Emergency measures were implemented, including guaranteeing deposits of Silicon Valley Bank's customers and closing down another failing institution, Signature Bank. The impact on the U.S. economy has been significant. with concerns of an economic meltdown in 2024. The collapse has invoked memories of the 2008 financial crisis, raising concerns about bailouts and the government's role in the economy. The political discord over the bank's failure has also foreshadowed a showdown over raising the government's borrowing limit. Looking ahead, top economists have expressed diverging views on the future of the U.S. economy. Some predict a recession by September and a credit crunch, while others emphasize the need for large institutions to adapt quickly. The Biden administration is in a difficult position, caught between managing inflation and preventing further damage to the wider economy. The state of the U.S. economy following the collapse of Silicon Valley Bank underscores the importance of stable financial institutions and effective political collaboration in times of crisis.